Hi, welcome to the world of investment planning. Welcome to the world of automating investments. So let us get started. So in case, here is a system which we have made in terms of which we call as automated investment solutions. So in case if you are a lead, which means you're not an existing investor to us, and you wish to get your investment solutions planning done by us. So just an example, how do we get started? So we choose the lead. We click on start planning. So we have three solutions for you. One is build wealth, second is regular income, third is save tax. Meaning to say that as an investor, you can primarily come to us with three requirements. One is for capital appreciation, which we call as build wealth. Second is the best way to get tax efficient income regularly, which is regular income solutions. And third is that you want to save tax with the best returns. So we call that as save tax. So supposedly, for example, if we choose build wealth, so we click on this and we click here. Now there are two ways of investments. One is through the SIP route, which is a monthly investment plan, and second is through a lump sum, which is a one-time plan. So supposedly we go in for a monthly plan and say our budget is 10,000 rupees, which we want to invest on a monthly basis. We choose the tenure. So we strictly believe for wealth creation, one needs to have a minimum horizon of 10 years. So this you can choose as high as 50 years, but just for example sake, let us choose 10 years. So 10,000 rupees for 10 years if you wish to invest. So what are the solutions available? So we have two options which best suits your risk appetite. One is aggressive portfolio and second is a diversified portfolio. Now what is the difference between the two? The aggressive portfolio will invest primarily in mid-cap and small-cap funds. The diversified will invest in a mix of multi-cap, large-cap, and mid-cap funds. So, by the name, it's very evident and clear that somebody whose risk appetite is better and wants higher return with higher risk should go in for an aggressive portfolio, and somebody who's having a lesser risk appetite should go in for a diversified plan. Now, just to give you some idea, in the last 10 years, aggressive plan has given investors a 14.6% return, and the value would have become 25,74,359. That is, if an investor would have invested 10,000 rupees per month for 10 years, the returns would have been 25,74,359. Similarly, in a diversified plan, in the last 10 years, the returns are 13.78% annual returns, CAGR returns, and the value would have become 24,63,739. Now let us move forward and see what are the options available and what is the risk versus reward ratio in this plan. So we've taken a horizon of 1 year, 5 year and 10 year for explanation sake that what is the maximum and minimum return. So the highest 1 year return in an aggressive plan is 243%, and a minimum return in 1 year is minus 51%. Somebody who invested 10,000 rupees for 1 year, the money would have doubled. That's the highest return, and the lowest, the money would have become half. Similarly, in a 5-year horizon, the highest return is 57%, the lowest return is minus 2.33%. In a 10-year period, the beauty is that there is no negative returns, and the highest return is 19.79% and the lowest return is 7.04%. In INR terms, if you want to see, so this is the value. So 1 year return has been 2,49,000 and the minimum 1 year return has been 82,000. It also shows the median returns. Similarly, in a 5-year plan, the money invested would have become 2,31,000, 23,16,584 and a minimum of 5,65,000. Similarly, for a 10-year option, 34 lakhs 4,272 and a minimum 17,23,795. So this is the returns of an aggressive portfolio. Similarly, if we were to see the returns of a diversified portfolio in terms of rupee terms and in terms of percentage terms, so this is the returns. Now this gives you a very clear picture as to what is the risk versus reward ratio when you invest in an aggressive portfolio versus a diversified portfolio. So it is clear that somebody who's risk averse should go in for a diversified portfolio, and somebody who's wanting to take risk and ready to get rewarded for that risk then should go in for an aggressive portfolio. So supposedly one chooses diversified portfolio. So we can finalize the plan. and move ahead. So which means that in a diversified portfolio, it's 100% equity. The rebalancing happens 5 yearly because we strictly believe that in a SIP, when you are contributing on a monthly basis, one needs to review and monitor obviously regularly, but at the same time we rebalance it every 5 years. So this is the portfolio constitution as of now, which consists of Axis Focus 25 Fund, Canada Robeco Equity Diversified Fund, Invesco India Contra Fund, Kotak Standard Multicap Fund, SBI Magnum Multicap Fund. So these are the 5 funds which we have chosen under SIP diversified portfolio. So once this gets finalized, so your money is invested into these 5 schemes. So if you are investing 10,000 rupees, so 2,000 rupees each goes into these schemes. Now obviously when we say the rebalancing frequency is 5 years, it doesn't mean that we are going to sit tightly invested in it. At the same time, in case if there is any major fundamental changes in the underlying scheme, we actually go ahead and change the underlying schemes. So once this is decided, we actually finalize the plan and actually we generate the order. So at the start I told you, because we had chosen a lead, so it's not allowing us to generate order, but then once you are enrolled as an investor to us, we can actually generate the order and everything becomes automated. So this is what we wanted to show under the automated investment solutions. Thank you for hearing us. In case if you have not subscribed our channel, please do subscribe our channel for more informational details like this. We wish you all the best and a happy financial journey ahead. Thank you so much.